And this is all about how we actually conduct business here at Zero-DTE and what our strategy is really based on, and that is asymmetric risk to reward. And what is it, and why is that so darn important? And I think the next slide is actually an unslide because it may not, let's see, does it have any content? Yes, asymmetric strategies rule. So what we're saying here is that our strategies are really predicated on an exaggerated risk to reward scenario. So we take a page out of the book of Asymmetry from Nassim Taleb in his book, The Skin in the Game, Asymmetry in Everyday Life, and Anti-Fragile, and particularly the Black Swan theory. And if you know who Nassim Taleb is, then you know that he made what he calls FU money by starting up a fund that is based on asymmetric principles. And that's really like the Black Swan fund, not really, but looking for these events that are relatively low probability of happening. And so the bet that you make is very tiny, but if it does happen, then the return on that bet is going to be huge. Now, another good example of that is that movie, The Big Short. If you remember those two guys that were in their garage that started a hedge fund, and they started it with $140,000, and what they would bet on are these undervalued companies and they would buy leaps, so they would spend small money, and if they lost, hey, no big deal. It was just a short change, but if they won, they made huge amounts of money, and they took that small $140,000 stake and turned it into $30 million. And then, of course, they made another asymmetric bet when Brad Pitt came down there and helped them, not Brad Pitt, but the actor Brad Pitt playing a legendary trader, helped them get onto the big boys trading floor and take advantage of the mortgage crisis, and made another asymmetric bet and made more money. So that's another example of asymmetry. But if you were to look at just about anybody that's successful in life, people who are successful, entrepreneurs, venture capitalists, people in real estate, any kind of artist that puts their effort into a particular craft and doesn't actually cost them a lot of money to make these bets, but if they can put it out there and it gets received well, they can make huge amounts of money. So they're also conducting a type of asymmetric strategy. Venture capitalists particularly. Venture capitalists will bet on 25, 50 different companies and invest small amounts in each one. And most of them may not do anything. A very small portion of them will grow up into something okay and pay for all of their expenses, and if they're lucky, they'll have invested in the next Microsoft or Apple, and that will make everything. Again, an asymmetric bet. Real estate, people that are in real estate, they're the ultimate in asymmetry. They don't even use their own money. They use other people's money to compound their investment. So in a way, that's exactly what we're doing here, albeit in a smaller scale and on a daily basis, because we are day traders, where we take asymmetric bets, small risk for potentially large reward, typically 1 to 9, 1 part risk to 9 parts potential reward. And so that means that we could put on a $100 bet and potentially return 900% back from that bet. Now, we don't always do that, but there is certainly room to, in a wide spectrum of types of returns that you could get between there. Getting that pinnacle bet happens less often. However, that still leaves us with a very enviable position that our risk is always very small. And because of that, our drawdowns are very small and our equity curves are very deplete of any kind of real heavy volatility. And so that affords us a great deal of comfort. We don't suffer from the anxiety that most traders do with high probability trades where they're putting up $1,000 to try to make $25. And that's the typical scenario for most Zero-DTE traders, particularly those that are trading iron condors or verticals. They're putting up a lot of money to make a little bit of money. And some people characterize that as trying to pick up nickels in front of a steamroller. And the problem with that is that, yes, they can put on a very high probability strategy and make that tiny little profit. But over time, there's going to come that time where they're going to hit their risk and it's going to wipe out a good portion of that profit. And in between those times, they're often in the red and filled with anxiety and panic of potentially hitting that max loss. Even though they do have a very high degree of probability of making that trade, they still are fearful of that loss. So if they get down to a certain level, they'll actually stop out, thereby taking their high probability trade and turning it into something much lower probability.